Everyone, welcome back to another episode of the Weekend Chart special edition. Today, I call the State of the Markets December 2025, last State of the Markets of this year. And we got a lot to talk about today: stocks, bonds, the Fed, real estate, housing, commodities, currencies, crypto, intermarket analysis, and we'll end with the U.S. economy. So without further ado, let's start out with the stock market and talk about U.S. stocks, which had their second correction of the year recently. A very minor pullback, a little over 5%. We're almost back at new all-time highs, recovering from there. You could see we had a bear market this year, 21% decline back in February through April on the trade wars and tariff fears, global recession fears going on back then. And then after that, it was really smooth sailing for the better part of 6+ months. We really saw just an upward advance without any real pullback to speak of. And then we had this little correction here, a little over 5% from October to November. And if we look at the major indices here, you could barely notice it. It's just a very minor blip for the S&P 500 here, and almost back to new highs within about 20 points of a new closing high. NASDAQ 100, similar situation, almost back to a new all-time high. And the Russell 2000 actually did recover from its losses during that correction, hitting a new all-time high. So all three major indices back within 2% of all-time highs. And it's been another very strong year for the U.S. equity markets overall. 36 more all-time highs for the S&P 500. That follows 57 in 2024, which was the fifth most of any year in history. So what's the big narrative this year? What's been driving the further progress in terms of the U.S. stock market? Well, definitely number one would have to be earnings, and earnings of late beating expectations. If we look at the third quarter, many companies beating estimates. If we look at overall here for the year 2025, we're looking at another record high in terms of earnings growth for the S&P 500. And the current expectations, we don't have fourth quarter numbers just yet. They're going to be released in January. And what they're expecting is for the full year, a 13% earnings growth rate for the S&P 500. And if we look at 2026, and this is going to explain probably a lot of the valuation metrics that I'm going to talk about in a little bit, we're looking at around 17% is the earnings growth expectation for 2026. So this year was a good year, double the historical average in terms of earnings growth, and they're expecting, at least right now, an even better year in 2026 in terms of earnings. And if we look at the third quarter here, much better than expected. This was the 11th consecutive quarter where we saw positive year-over-year earnings growth for the S&P 500, but 22%. You could see the acceleration here from prior quarters, the highest growth rate we've seen in about 4 years for the S&P 500. And if we look at profit margins, this has been the big story this year, and particularly in the second and third quarter. Margin expansion here. We only have 4% of companies still to report, but we're on pace to see a new record high in terms of S&P 500 profit margins, 13.6%. That would surpass the prior high from 2021, which was 13.5%. So that's the story in terms of fundamentals. Very strong earnings growth, increase in profit margins. But we've also seen, this would be the third consecutive year of this, multiple expansion. So right here, we're looking at the price to peak earnings ratio for the S&P 500. It moved up to 26.2 in the third quarter. That was about 50% above its historical median, and it's also the highest level we've seen for this ratio since 2000. And if we look at price to sales, we hit a new record high in the third quarter, around 3.3, double the historical median in terms of price to sales ratio. We've never seen this higher for the U.S. equity market than it is today. And if we look at the full year, this is a chart I like to compile each and every year and really illustrate, break down what is going on in the U.S. equity market. How do we get to the return that we have? And you can see here, 13% is the projection for earnings growth. We still have the fourth quarter to be reported, but that's the expectation. And the S&P 500 is up 16.6%. That's the price return. And you can see that means that you have a little bit of multiple expansion. So if we're looking at trailing 12-month PE ratio, it would move up to 26. That would be a 3% multiple expansion. Not big compared to the prior 2 years, but that would be the third consecutive year of multiple expansion for the S&P 500. And if we look at the CAPE ratio, which I like to illustrate because it smooths earnings over a longer period, so you're not so reliant on just the recent 12 months earnings or looking at forward earnings, which can often be unreliable. This has moved up to 40, which I've talked about being a little bit of a warning sign here, because the only time that we saw this valuation this high was back in 1999 and 2000. Now, it was higher in 2000 than it is today, but other than that period, 1999 to 2000, we've never seen this valuation metric this high. And what that has meant historically in the short run is absolutely nothing. It's not predictive whatsoever of what the S&P 500 is going to do next month or the next few months or even the next year, because that all depends on sentiment. So if sentiment is stronger at the end of 2026 than it is today, then we'll see this valuation metric move even higher, and that could mean further strong gains for the S&P 500 regardless of what happens with earnings. So the big factor in the short run is always, what is the change in sentiment? Are investors more optimistic? Are they more pessimistic? But historically, what we've seen is an inverse relationship between valuation and longer term returns. So we're looking at here the S&P 500's CAPE ratio by decile and what the S&P 500 has done annualized over the next 10 years from each of these deciles. So as you move up in terms of the S&P 500's decile, meaning lower valuations, you tend to see stronger future returns. And in the top decile, so highest valuations, you see the lowest future returns. So if you believe in mean reversion, what you should expect is lower future returns for the S&P 500 if you think this valuation level is going to be lower 10 years from now or 5 years from now or any period than it is today. Then you're going to have a multiple compression, and that will reduce the rate of return in terms of your investment in the S&P 500. Now let's talk about some ratios. What's going on within the equity market? Well, entering this year, we saw 16 plus years of U.S. domination, U.S. outperformance versus international stocks. And then pretty much on day one of this year, we saw something interesting. You saw a complete reversal. You saw international stocks outperform, so this ratio started to move down very sharply in the first quarter of the year. We saw one of the biggest spreads in terms of international outperformance ever for a quarter, looking at the first quarter of this year. And then since then, U.S. has really been clawing its way back, but we still have a valuation gap here that's pretty notable and pretty sizable, given that we haven't seen this in a long time. We haven't seen international stocks outperform U.S. stocks by this margin in a long, long time. So what we're looking at here is emerging market stocks up about 32% year to date so far, European stocks up 32% year to date so far, and the U.S. equity market still very strong, up 18%. But first year in a while, we've seen it be the underperformer in terms of global equity markets. And if we look at this table, it really illustrates by country and region what's going on within the equity market. And we have the U.S., we haven't seen this in quite some time, in the bottom third in terms of country performance year to date. Still, again, a very strong return, 18%, but you could see some of these returns enormous. If we're looking at international equities here, South Korea up 85%, Greece 74%, Peru 72%, Spain 70%, Eurozone area really leading the way up 37%, but you can see EM, Europe, the global market as a whole, ex-US, up over 30% versus 18% for the S&P 500. And if we look at within the US equity market, what's going on with the Mag 7, this is very interesting because the last few years we saw pretty much these 7 names move in tandem. And what I mean by that is they've either all outperformed the S&P 500, that was the case in 2024 and 2023, or they all underperformed the S&P 500. That was in 2022 when we had that bear market back then. But this year, very different in terms of returns here. Big dispersion here between the leading company, Google, that wasn't the case in the first quarter this year. Google was lagging, but now up 70% on the year. Nvidia having another strong year, 36% gain. But the rest of the Mag 7 actually underperforming the S&P 500, which I think would shock a lot of people. S&P 500 up 18%. You see Microsoft, Meta, Tesla, Apple, and Amazon all underperforming the overall S&P 500. So if we look at the different factors going on within the U.S. equity market, the big story for the past decade has been the outperformance of growth stocks, and a lot of that has been driven by technology stocks. But of late, we've seen a little bit of a reversal from this. So in October, this ratio hit an all-time high. It was above the peak from March 2000 during the dot-com bubble. But since then, we've seen value stocks actually outperform growth stocks over the past month and a half or so. And within the growth sector, what's been the big driver of that? Well, it's been the technology sector. And similar to the growth versus value trade, we saw this peak in October, and over the last month, we've seen a little bit of underperformance from tech, but you could see just enormous outperformance over the last 15 years for the U.S. technology sector versus the broad market, and that too is above the March 2000 peak. In terms of S&P 500 sectors, everything positive so far this year, but you can see a pretty sizable spread here. Technology, best performing sector, consumer staples on the defensive side, worst performer up 1.7%. So you got tech up 26.7%. Everything in the green. I would still say it's favoring the cyclical sectors, meaning market participants are betting on continued growth in terms of the U.S. economy, or you wouldn't see these sectors lead: information technology, communication services, and industrials. So what we're looking at in terms of large versus small, very important chart here, I think, because it goes back pretty much to the late 1980s here, and we're looking at large versus small. And April of this year, when we had that bear market, we saw this ratio hit its highest level since April 1999. And since then, we've seen small caps clawing their way back. So trying to fight back in terms of catching up to the S&P 500's performance overall. And as I'll show you in a little bit, we're almost there in terms of small caps versus large caps on a year-to-date basis. But in terms of valuations, we talked earlier about the S&P 500 and its CAPE ratio and its price to peak earnings ratio all being the highest we've seen since 2000. If we look at other areas within the U.S. equity market, not as extreme in terms of valuation. If we look at small caps and mid caps, what I'm showing you here are forward PE multiples for the Mag 7, for the S&P 500 overall, and small and mid caps. You can see the Mag 7 is the big driver really of that higher valuation for U.S. large caps. And you can see here in the red, large caps trading about 22 times forward earnings. Got the Mag 7 about 30 times, and small and mid around 15 to 16 times. So a pretty sizable gap. And if you're going to make the case for small and mid going forward, part of that I think would be on a valuation basis. If you think this gap here is going to converge, it's not always the case. It might seem like it is that large caps trade at a premium. That's certainly been the case in recent years, but you could see going back 10 years ago, they were actually trading at a discount to small and mid cap stocks. So if we're looking at small caps year to date, they're up. If we're looking at the Russell 2000 ETF here, 14.4%, so lagging by about 4%, but the spread was much, much wider if we go back to April in terms of the small cap underperformance. But the big story so far this year has been the international stock story. Look at international developed market ETF here, VEA up 32% year to date. And if we look at concentration, back in October, I was talking about this a lot because we hit another record high. Over 40% of the S&P 500 was in just 10 stocks, just the largest 10 stocks in the index. That was a record high that we've never seen before. And since then, we've seen this come down a little bit. It's about 39.5%, but still would be a record high for any calendar year if the year ended today. And what was the big driver of that? Of course, the number one stock, biggest stock in the world now, which is Nvidia. It hit a $5 trillion market cap back in late October, first company in history to hit that $5 trillion mark. So if you're thinking about next year, wondering how to position yourself in terms of your equity portfolio and everything else, at Creative Planning, we're here to help. So reach out to us. Go to creativeplanning.com/Charlie. I'll have a link in the show notes. Fill out this form, schedule a call or a meeting with an advisor today, and receive a free wealth path analysis. At Creative Planning, we're located in all 50 states and abroad as well, so we likely have a location right near you. Over 385 billion in assets under management and advisement, and we're here to help. So reach out to us today, creativeplanning.com/Charlie. Next, I want to talk about the bond market, talk about the Fed meeting. We have a big meeting tomorrow, and the inflation picture in the U.S. If we're talking about the bond market, very different than the U.S. stock market, because the bond market has been in a drawdown for over 5 years now. So 64 months in terms of this drawdown. It peaked back in 2020 when we had the lowest interest rates in history, and that normalization as interest rates went higher over the last 5 years was crushing to bond market investors. But we've been slowly clawing our way out of this 17% drawdown. The drawdown is now less than 2% as of the end of November of this year. And a big part of that is interest rates on the long end coming down, and also on the short end because of the Federal Reserve cutting interest rates, that coming down as well. So if you look at the bond market this year, overall, very strong year for the U.S. bond market. What's been leading, similar to the stock market, has been international, particularly emerging markets here. Emerging market local currency up 17%. Sovereign debt from emerging markets up 13.5%. High yield bonds doing well there as well. U.S. high yield doing well as well here, because spreads have been coming down. They've been tightening. But overall, U.S. bond market up 7% this year. Very strong year. That would be the best year we've seen since 2020. So it was a difficult 2021. 2022 was the worst year for the U.S. bond market in history, down 13%. But the past few years, the comeback in the bond market has been expected because we had higher yields. So what is the relationship between the bond market and yields? Well, it's not like the equity market. There's no correlation between interest rates and stock market returns, but there's a very high correlation between what is the starting interest rate and what is the return you get from the bond market. So the starting interest rate today, 4.14% in terms of the 10-year bond yield. If we adjust that for inflation, look at real yields, you're still at close to 2%. And why is this important? Because this is the single best predictor in terms of 7-year bond returns. Nothing comes close, 97% correlation here. So what should be your expectation in terms of what are bonds going to deliver over the next 7 years? It should be around that 4% area. 4 could be 3%, could be 5%, but 4% would be kind of your median expectation. Assuming interest rates stay where they are, you're going to get that coupon of around 4% over time. In the short run, what determines bond market returns is simply the direction of interest rates, but in the long run, it's all determined on that level of interest rates. So higher yields for bond market investors going to be a much better 5 years looking forward from today than 5 years ago, which was pretty much the worst period in history for the U.S. bond market. And if we look at the credit markets, risk appetite still very, very high. Earlier this year, we hit tights in terms of the credit spreads that we haven't seen in a long time. Investment grade spreads were at their lowest level since 1998. High yield spreads hit their tightest levels since 2007, and they remain very tight here. We're looking at investment grade spreads about 80 basis points above risk-free treasuries, and high yield spreads 2.88%, still very low, you can see, compared to their historical averages. And if we look at the yield curve here, a little bit of steepening so far this year, but nothing to write home about. We got about a 58 basis point spread between 10-year and 2-year yields here. 10-year 4.14%, 2-year at 356. What's driving that 2-year lower, of course, is that the market is expecting the Fed to cut interest rates here. This is the curve here of Fed fund futures. We're close to the end of 2025. Tomorrow, the Fed will likely cut interest rates once again, bringing the Fed funds rate down to 350 to 375. And what is the market betting for 2026? Right now, as I'm talking, they're betting 2 more interest rate cuts for 2026. But as we know, that can change and change a lot in a very short period of time, depending on data, depending on the Fed's projections. depending on many, many different factors. So what I would say is really what's reliable in terms of the Fed fund futures is the very short term. And you can't get shorter than tomorrow. And so what is the market expecting for tomorrow's FOMC meeting? Definitely an interest rate cut here, close to 90% probability priced in. And what I always say is since 2009, every single FOMC meeting, the Fed has done exactly what the market has been expecting it to do. So here with a 90% probability of a Fed rate cut tomorrow, it's very, very likely the Fed is going to indeed cut rates once again. But the January meeting, we don't yet know. It seems like right now the market's betting the Fed will pause, but a lot can change between now and then. This is not very reliable. So in terms of Fed interest rate cuts, what should you be watching tomorrow? They'll likely cut, but the bigger focus is going to be on their projections. So their dot plot projections for 2026. And in the September meeting, what they were saying is really they were only going to cut one time based on their projections in 2026. So it'll be interesting to see if they hold on to that or they lower it to meet the market, which is saying the Fed is going to cut two times, or if they raise it. So we don't really know yet what the Fed's expectation is. We know the market believes the Fed's going to be more dovish than their own projections, but that's going to be an important thing to watch along with their updated projections for economic growth, for unemployment, for inflation. And if we look at where the Fed funds rate is relative to their preferred measure of inflation, which is core PCE, you could see here there's almost a 1% gap. And this is what they're going to be using to justify additional rate cuts here. They're going to say, well, because we're almost 1% above where inflation is today, this is tight monetary policy, and we can err on the side of easing. We can bring interest rates lower, so they'll likely do that. But what I've been saying, why I've been pushing back against interest rate cuts is because the Feds should be looking at more than just the last year. So even if we just looked at the last year, core PCE is at 2.8%, CPI is at 3%. To me, that shouldn't be the only rate they're looking at in terms of inflation. They should be looking at a longer period of time, cumulative inflation over a period of time. What we've seen since the beginning of 2020 is an inflation rate in the U.S. that's double the Fed's own target, which is 2%. So we've seen 4% annualized inflation since the beginning of 2020. And the Fed, in my view, is making a mistake here in saying, we don't care about this, we're going to cut interest rates anyway, we're going to focus on inflation sometime else. So I think that's a big mistake. I think they're going to cut anyway, regardless of that. But what good is having a 2% inflation target if you're not going to adhere to it? And in terms of the inflation data, the government shutdown really pushed back a lot of the data points that we have. But if we look at the Cleveland Fed here, what they're projecting for October and November in terms of inflation, they're saying CPI is going to stay around 3%, and even December not come down very much. And they tend to be pretty close to where this number comes in. So they're not expecting inflation to be moving towards the Fed's 2% target anytime soon. And if we're looking at the longer term bond yields, I think this is an important thing to talk about because a lot of people assume that the Fed's interest rate cuts are going to also bring down mortgage rates and other longer term debt instruments. That's not necessarily the case. And we've actually seen since the Fed started cutting interest rates in September 2024, they've now cut 150 basis points on the short end. So cut 1.5%. And they'll likely cut another 25 basis points tomorrow. And what we've seen is the 30-year yield move from below 4% to now 4.8%. So what this tells me is the bond market is saying that the Fed might be done with inflation, but inflation isn't done with the Fed. So inflation is still here. The bond market, longer term investors are clearly pricing that in. In addition to that, of course, you have the mounting debt load in the U.S., 38 trillion and rising very, very fast, likely to hit 40 trillion in 2026. And all of these pressures are putting a upward pressure on longer term bond yields. So my expectation is the Fed stopped quantitative tightening at the end of November. I didn't think that was warranted. I thought they should continue to unwind their balance sheet. We're not in a crisis. Why can't they let the balance sheet continue to run off? Nevertheless, they stopped quantitative tightening at the end of November, and I think that this is paving the way for quantitative easing at some point in 2026. So what they're going to be saying is we cut interest rates 1.5%. It's going to be probably at 2% of cuts at some point in 2026, but longer term yields are not coming down, and therefore we need to start doing yield curve control and doing quantitative easing. That's my expectation. Hopefully that won't be the case, but I think that will be coming at some point in 2026. Let's talk about real estate and the housing market here. Very interesting to see with the S&P 500 hitting all those all-time highs, 36 more of them this year, 57 of them last year, that the real estate index, so REITs within the U.S., has not hit an all-time high since you got to go back to early 2022. So really both of these markets peaked in early 2022. You had bear markets in both of these, but the real estate sector has not recovered in the U.S., still in a 10% drawdown, despite the overall equity market being so strong over the past few years. And one of the big reasons for that is simply reflecting commercial real estate prices still in a drawdown here from its peak, around 16% drawdown from peak levels. So reflecting that, and of course reflecting the new reality in terms of interest rates in the U.S. We're not back to that 0% policy that we had for a long, long time that really drove up commercial real estate prices. And looking at the real estate sector to the S&P 500, fascinating to see this chart. Look where it is today, because back in 2007, people could not get enough real estate. This was at the peak of the U.S. housing bubble. February 2007, this ratio peaked. So you saw massive outperformance of the real estate sector versus the S&P 500. And since then, we've seen a decline here. And now we're at the lowest level since July 2000 in terms of this ratio of U.S. real estate to the S&P 500. So you can see very long cycles of sector outperformance, and in this case, underperformance in terms of U.S. real estate. If we look at the housing market here, the big story this year has been affordability, affordability, affordability. Been the case for the last few years. I've been calling it the least affordable housing market in history. So you see home prices still hitting new highs this year, housing affordability remaining very, very low. There's a huge gap between the amount of income that you need to afford a house and your actual income, 57% gap. That's the widest we've seen in history. And simply the payment that you need to afford buying a home today is untenable for most households within the U.S. You would have to spend about 47% of your income to afford that, which most people, they couldn't get a mortgage at that high of a percentage of their income. And even if they could, it wouldn't be advisable for them to do so, because they would have nothing left to spend on anything else, nothing for savings, nothing for entertainment. Everything would be spent in terms of housing. And so what we've seen slowly but surely here is a readjustment in terms of the housing market, where supply is starting to outpace demand in a lot of areas of the country. And so we're seeing here not huge supply numbers, but much more of a normal supply picture than we've seen in the past few years. So we saw record lows in terms of supply back in 2021. Even 2022 was very low. And the past few years, we've seen just a gradual increase in terms of that supply. And now here, the latest number we have for November 2025 is about a 13% year-over-year increase in terms of the number of U.S. listings. And that's the highest we've seen since 2019. So hopefully the supply picture continues to improve, and what we see is the housing market become more affordable. It's already starting, in my opinion. If we look at the Case-Shiller National Index, and this is as of September, so it's a few months delayed in terms of the data here. It's up 1.3% year over year. That's the slowest rate of home price appreciation we've seen in a few years. If we look at real-time metrics here, looking at Zillow's U.S. housing market index, essentially flat over the past year. And if we look at the housing market in the U.S., we know every area is different. Many cities are still going up, but now we're seeing something flip here, where we're seeing more cities decline than go up in terms of their year-over-year rates of appreciation. 11 out of the 20 cities in the Case-Shiller Index now down on a year-over-year basis. That's the most we've seen in a few years. And you can see here just the gradual rate of appreciation slowing. So we had that huge record housing market boom in 2020, 2021, driven by, in large part, the stimulus, the money printing, the artificial interest rate picture with the Fed buying trillions of mortgage bonds. And what we're seeing now is a slow normalization in terms of the housing market slowly becoming more affordable. And I'd say the area that's leading this charge in terms of affordability would have to be Florida. We're seeing much more supply coming onto the market here. I'm showing data via Zillow here of various housing markets in Florida. Miami down 3%. You got Fort Lauderdale down 5%, Fort Myers 12%. So pretty much across the board within Florida, we're seeing declines. And if you've been waiting to buy a home, obviously this is good news. You're seeing more affordability. You're seeing prices come down. Of course, they don't tend to come down as quick as the stock market because people are reluctant in terms of selling. If they see the price going down, they might wait. They might pull the house off the market, which we're already starting to see that. But eventually, prices should get back closer to affordable levels, assuming we don't do what we did back in 2020 and 2021 again, if we don't try the engineering in terms of money printing and doing another round of stimulus. So headed in the right direction here. And I think the good news is if you're in the rental market and you're waiting to purchase a home, you're being essentially paid to wait because it's cheaper to rent a home or rent an apartment than it is to buy in all of the major metro areas in the US, all 50 of them. It's cheaper to rent than to buy. And what we're seeing in terms of the rental market is no new highs. So unlike the housing market in terms of home prices, the median monthly rent in the US via apartment list here, that peaked back in 2022. So we're talking about over 3 years with no new highs in terms of median rents in the US. And on a year-over-year basis, we're seeing rents down 1% over the past year. That's the 30th consecutive year-over-year decline. And what's driving that? Well, it's supply and demand. So what we're seeing is vacancy rates go up, and because of that, you see this rate of appreciation slow down and decline in many areas. What we're seeing now is the highest vacancy rate that we've seen, with data going back to 2019, which is 7.2%, which means this picture should continue to improve for at least a few more months. So let's now talk about commodities. And the big story this year, of course, has been gold. 60% return for gold in US dollars here. That's the best performance, on pace to be the best since 1979. So you have to go back a long way. Silver doing well, extremely well this year, hitting a new all-time high above 50. You have gold versus the broad commodities, huge outperformance with this ratio rising here. And gold almost in line with the S&P 500 now over the last decade, which is pretty remarkable given this huge surge in gold prices over the past few years, catching up here with the S&P 500, and broad commodities lagging. If we look at the last 20 years, gold lagging the S&P by a little bit, but it was lagging by a huge margin a few years ago. So really closing this gap. Very different path to getting here. Both of these returns are up about 11% per year over this period of time, last 20 years, but very different path in terms of how they got there, with gold, of course, starting out very strong, the equity market having a difficult time in the beginning and then reversing course. So very little correlation between gold and the equity market historically. What's been interesting is the past few years seeing gold and stocks rise together, and this year as well. And if we're looking at gold versus inflation, this is an important chart to look at because investors often ask, well, how do I value gold? And there's not really a way to do it similar to the equity market or the bond market. There's no real dividend or underlying cash flow to value. There's no earnings, of course. But if you compare it to inflation and look at the average, you can tend to see what historically has been a high price to pay for gold relative to inflation and lower price. Of course, the extreme of that occurred in the early 1980s when it surged much higher than the rate of inflation. That portended a bad period of returns for the gold market. And then a very strong period of gold started around 2000 when it had underperformed inflation by a huge margin over the previous decade. And of course, now here we are at a new inflation adjusted high for the gold market. Naturally, investors very excited about gold, but if you look back at history, excitement has caused this ratio to go up, and that has portended poor future returns. So anything could happen going forward, but this is just one way to look at gold on an inflation adjusted basis. And if we look at the period of 1 year here for the commodities market, silver, number one commodity, 82% gain, gold up about 58%, number two, everything else trailing off after that. And you have, importantly here, gasoline and crude oil down in the negative level, which drive a lot of commodities, input costs, and prices there. So if we look at the broad commodities, this does not look like the stock market or look like gold over this period of time. Very different. February 06 was the first commodities ETF that came out in the U.S. DBC, 14% return over this period of time. Needless to say, a very, very low return for an almost 20-year period for an ETF. So it hasn't been a very good story being a long-term holder of commodities. And a big reason for that is simply the technological innovation and the fact that we can extract commodities at a much lower cost today than we did in the past. And if we're looking at the price of gasoline, good news here in terms of commodity prices. First time on a national average, U.S. Gas prices are below $3 a gallon. First time in 4 years that we've seen this. Hopefully prices stay low. This is definitely good news. Let's talk about currencies here. Dollar index was a huge story in the first half of the year. Second half, not so much. We just seen it move sideways. It was the worst first half of the year for the U.S. dollar index on record. It was down over 10%. But since then, it's essentially traded sideways to even slightly higher. Hasn't done very much at all. If we look at the last decade now, essentially flat in terms of the dollar index with some swings back and forth, about 10% on the downside, a little over 10% on the upside. But here we are 10 years later, essentially flat. If we look at a longer term chart of the dollar going back to 1973 when the index started, we're pretty much where we started in terms of the index with big rallies and big sell-offs. So a lot has been talked about in terms of the dollar this year, but really, even though that first half move was pretty extreme and the worst we saw on record, on an overall basis, if we look at the dollar index decline this year, nothing to write home about, pretty normal. Dollar is moving on many different factors, right? You have interest rate differentials between the U.S. and other currencies, other countries. You have growth expectations, so changes. You have capital flows. You have trade flows. So a lot of different things driving the dollar back and forth. I think the biggest factor this year, if we look at the first half of the year and what was going on, particularly the first quarter, was the huge front running of the U.S. tariffs. So what we saw in the first quarter was a massive amount of imports, as we'll talk about later, of the U.S. importing goods to avoid that tariff, the higher goods price that they were going to pay with the tariff after they were imposed. And I think that really led to a lot of demand for foreign currencies because you're buying more international goods in that first quarter, and that helped the dollar come down. And since then, we've seen a leveling off. So in terms of interest rates here, this is a tricky one because this is really based on expectations, not just where we are today. Because if it was just based on where we are today, well, you can see clearly the U.S. in terms of real interest rates much higher than the Eurozone and the Bank of Japan. So the major currencies in the U.S. dollar index are the euro and the yen, and you can see the Federal Reserve has a much higher interest rate relative to inflation in the U.S. than both the Eurozone and the Bank of Japan, which have negative real rates. So if it was just on that, you would be expecting the dollar, all else equal, to increase over time. And why we haven't seen that is probably because, well, one, the expectation that the Fed is going to continue easing here, and so this differential will be closed here. And perhaps that the Bank of Japan is getting closer to hiking interest rates again. That seems to be the expectation for some time early in 2026. And that the Eurozone is close to done, perhaps cutting interest rates. They haven't cut since June of this year, and they're already in negative territory in terms of that negative real rate. So many different things impacting the dollar. That will be true in 2026 as well. Impossible to predict the direction of currencies. And as an equity investor, I would say don't do it because there's really no relationship historically between the direction of the US dollar and US equity market returns. We've seen 10% return for the US equity market when the dollar has been rising in a particular year, and 10% return for the US equity market when the dollar has been going down in a particular year. So, really, no relationship whatsoever. That doesn't mean you don't want to see the dollar collapse. We definitely don't want to see that. But when it moves up 5, 10% or down 5, 10%, really historically it hasn't meant much in terms of performance. What has meant a lot in terms of your international stock performance this year is that falling dollar. So international currencies getting a boost. So if you're a US investor, you own international stocks, you're getting a high return so far this year because we're seeing that currency appreciation relative to the dollar. Let's talk about crypto here. Bitcoin, Ethereum, the big two, over 70% of the crypto market. You can see the recent declines in both of these. Bitcoin was down a little over 30%, Ethereum down a little over 40%. Bitcoin prior to that decline was on really a huge tear higher. It went as high as 126,000 in early October before pulling back, and we've seen these pullbacks pretty much every year, and we've seen now two of them this year. 36% was the current decline. We don't know, could it go deeper for sure, but if we look historically, we've seen this pretty much every year. This was late November here where it bottomed at around 80,000, down from 126,000. The bigger correction for Bitcoin, of course, can be 50, 60, 70, 80% declines. We saw during the 2021, 2022 bear market a close to 80% decline, 2017 to 2018 bear market over 80% decline. And the interesting thing I've been talking about in the past few weeks has been this divergence between Bitcoin and the Mag 7. So Bitcoin has been trading more like a risk asset really since the ETF came out. In terms of the first Bitcoin ETFs came out in early 2024, you're seeing more a correlation in terms of Bitcoin's short-term performance and the overall stock market's short-term performance. But here I'm highlighting the Mag 7 versus Bitcoin. You could see really until early October, they were kind of moving in tandem in terms of the return path. And we've seen just a pretty sizable divergence here between the two since then, with the Bitcoin ETF going down over 30%, Mag 7 having a pullback in November there, but nothing to write home again. Similar to the S&P 500, you almost are back at new highs in terms of the Mag 7 ETF. So over the last year, Mag 7 ETF is up 26%, Bitcoin down a little over 10%. And the question is this correlation broken, or are we going to see these converge? And if you think they're going to converge, you're of one of two opinions. Number one, if you're on the bullish side, you would say Bitcoin's going to have a huge rally here, catch up with the Mag 7. If you're bearishly inclined, you would say the Mag 7 is going to go down. Bitcoin's leading, and we're going to see it converge to the downside. And in terms of MicroStrategy, a lot's been talked about in terms of MicroStrategy, the Bitcoin treasury company that's issuing convertible bonds to go out and buy Bitcoin. That's really what it does now as a company. It's overwhelming everything else that it does. And the interesting thing we talked about during the MicroStrategy decline was the fact that it was trading at this huge, enormous premium to the Bitcoin it owned a year ago, so over 3 times the value of its Bitcoin back in November 2024. And then after this decline here went down over 60%, MicroStrategy, far in excess of the Bitcoin correction, what you saw is actually its value go down, its market value go down below the value of its Bitcoin. So some would say from a sentiment perspective, this is a better position for the crypto market today because we don't have this excessive optimism that we had a year ago, where people were expecting so much out of crypto that they would buy an asset that they would pay 3x more than the underlying value of the asset. And so the question longer term, I talked about it on the last week in charts, is there going to be a moment at some point in the next few years where MicroStrategy has to sell their underlying Bitcoin? That's not a question for today. They don't have this convertible debt coming due, but the question will be, if the Bitcoin that it holds was purchased at a higher level than where Bitcoin is when this convertible debt comes due, well, then people won't convert to stock. And then you have potentially have a situation where they're going to be asking for their money back. How does MicroStrategy get that money back? They either have to issue new debt or they have to sell some Bitcoin to pay that back. But we're not not at that moment now. If you look at the maturity dates in terms of that convertible debt, that could be an issue in 2026 at some point, in 2027 or later, but not an issue for today. If we look at Bitcoin's annual returns here, we're essentially even on the year with huge volatility in between. Bitcoin's at least 3 times more volatile than the U.S. equity markets. You should expect enormous swings, and anything that was up over 100% in 2023, 2024 to see 30, 40% corrections, nothing to write home about. Right now, we're about even on the year, and every few years we've seen in Bitcoin a pretty sizable decline. So the question is that coming again in 2026? You could see the pattern here: 3 straight gains, decline, 3 straight gains, decline. Are we going to see something similar in 2026? Nobody knows, of course. Let's talk about intermarket analysis here. First, comparing stocks to bonds here. Record high stocks outperforming bonds here. You would expect this in a bull market. You expect this in a strong year for the stock market. This was the tariff tantrum back in April. You could see the huge outperformance of bond stocks underperforming, but pretty much a V-shaped recovery, hitting new highs here. Stock bond correlation, we talked a lot about that in the past few years, but we hit a peak here, and it seems like that will be the peak of the cycle. This is a rolling 3-year correlation between the two. Still pretty high rolling 3-year, but if we look at the 1 year, you can see the correlation breaking down here, down to 0.16 here in terms of the last year between stocks and bonds. So what that simply means is they're not moving in tandem like they were for a few years. We're actually seeing, when the stock market goes down, we're actually seeing the bond market behave more like it was behaving pre-2020, which is to say that the bond market is rallying when stocks go down. You're seeing yields fall. So I think part of that is the recessionary type of fears that are going on today when the stock market goes down. And when that tends to happen, you tend to have the bond market rally because people are thinking the Fed is going to cut interest rates if there's going to be a recession, and people are thinking inflation is going to come down if you're going to have that situation. So a more normal environment in terms of stock bond correlations. Correlation does not mean returns. I think this chart really illustrates that. The last 5 years, S&P 500 has had a great run, 98% return, while the bond market has been down. So while the bond market hugely negative impact from rising interest rates from record lows, you can see here, stock market clearly not the case. So there's no historical correlation whatsoever between interest rates and the stock market. People often confuse that. They think low interest rates are good, high interest rates are bad. They think rising interest rates are bad, falling interest rates are good. None of it's true. There's zero correlation historically. The stock market has done just fine with rising interest rates historically, and we've seen that once again over the last 5 years. But the bond market, not so much. Very difficult to see rising interest rates when you have no cushion to start with. So you're at close to 0% on the 10-year back in 2020. Well, that's going to be disastrous if you go above 4% where we are today. If we look at the last 7 years, what's driving the 60-40 portfolio? Mostly the stock market here. You can see 11% around return for the 60-40 U.S. portfolio, but big gap between stocks and bonds, 16.5% for stocks, 2.3% for bonds. And as we talked about earlier with the bond market where it is today, you would expect this number to be better over the next 7 years because interest rates are higher. So you would expect it to be around 4% if interest rates don't go anywhere. And the stock market, of course, historically has done about 10% per year. So you if you're going just based on that, you would say the stock market is going to not do as well over the next 7 years that it's done in the past 7. So if we're looking at 60-40 breakdown 7 years from now, my guess is you're going to see this gap narrow here between stock performance and bond performance. But looking at stocks relative to commodities here, bull market behavior, stock market outperforming bonds. That wasn't true in 2022 during the bear market. We saw bond prices, commodity prices go up We saw an inflation at its highest level since the early 1980s. You saw a huge outperformance in the commodity sector back in 2022. But since then, stocks, 3 years of very strong outperformance. Stocks versus gold, different picture here. You can see we're about even now over the last 10 years in terms of the two. And of gold, of course, outperforming stocks this year, causing this ratio to come down. Bitcoin versus the S&P 500, because Bitcoin's volatility is so much higher than the S&Ps, really what this comes down to is really mostly what is Bitcoin doing? What is Bitcoin going up a lot? Is going down a lot? And recently it's been coming down, so you're seeing this ratio come down. And I think it's interesting to note here that from Bitcoin, the peak of this ratio back in 2021, we're now below that level, so which means that from Bitcoin's peak in 2021, we're actually seeing the S&P 500 outperform Bitcoin over this period of time. So essentially over the last 4 years, S&P is outperforming Bitcoin. I think that probably would surprise a lot of crypto investors. If we're looking at Bitcoin versus the gold ETF here, seeing something similar. Now Bitcoin underperforming gold over the last 4 years, certainly this year being the big factor, in the last few months being the huge factor, where gold has held its gains and Bitcoin's in this 30% correction. If we look at asset class returns this year, fascinating to see. We have a few weeks to go in the year, but we haven't seen this before. If this ends up being the picture at the end of the year, this would be definitely something new. Gold at the top of the picture in terms of major asset class returns, up close to 60%. And Bitcoin down on the year. Again, we still have a few weeks to go, so this certainly could change. And given Bitcoin's volatility, it wouldn't take very much for it to climb the performance rankings here very quickly if it got a year-end rally. But needless to say, we haven't seen this before, with gold being number one and Bitcoin all the way at the bottom. Interesting divergence, because early in the year, they were trading in tandem. Digital gold and physical gold were number one and number two, but now we're seeing this huge spread. So let's end the state of the markets talking about the U.S. economy. And it's a little bit of a cloudy picture because due to the shutdown, we're missing a lot of the economic data that would have been released. So the jobs report, we got 2 months now that are missing. Inflation, we're missing October numbers. We're missing third quarter GDP, which would have been released by now, and some of the international trade data. Retail sales is a month behind. And we're missing 2 months for housing starts and permits. But that said, it seems very likely from all the other data that we have that the U.S. economy is still expanding. We're seeing 62 consecutive months through the first half of the year of an expansion. That likely continued in the third quarter. Atlanta Fed's latest estimate is 3.5%. It was over 4% for a while. That's what they're projecting right now. If you look at Wall Street, they're projecting over 2%. So highly likely third quarter was a positive number. And some of the drivers we've talked about, consumer spending still pretty robust, so that contributing. And we're seeing AI investment become a bigger part of GDP growth. Some estimates here are saying perhaps it's contributing as much as 1% to overall GDP growth. So maybe half of overall GDP growth this year in 2025 will come from AI-related investments. If we look at the trade deficit here, this is clouding a lot of the picture in terms of what's going on in terms of price increases from the tariffs and other things, which is still up in the air. We have Supreme Court ruling still to come out on this, but nobody really expected the trade deficit to be going up, I think, this much, 25%. The intention of the tariffs was kind of to reduce the trade deficits. And instead, we're seeing the trade deficit widen. The reason for that is simply companies in the U.S. really to front ran the tariff announcement. So they bought a lot of goods in the first quarter of 2025 to avoid paying the higher prices with the tariff. So in terms of the impact, we're really not going to see that until late this year. So really now, if we had the data, which is lagging due to the shutdown, and early 2026, when these companies now have to go out, their inventory has been depleted that they built up from the first quarter of this year, they have to go out and make these purchases. And then are they going to try to pass that on to the consumer, and many other impacts? So it's really been a year of really deferring what's going to happen because of that massive increase in imports that we saw in the first 3-4 months of 2025. In terms of the jobs market, clearly slowing. A number of indicators here we can look at. unemployment rate just ticking up here to 4.4%, highest we've seen since 2021. The historical average is 5.7%, so still clearly on the low side, but something to watch because historically you can see once it starts going up, it tends to continue to go up. Doesn't mean it has to this time. Maybe we're going to be in a different period here where it stops somewhere below 5%, but historically that hasn't been the case. You tend to see this thing once it starts rising to keep rising. We're seeing jobs growth in terms of the number of jobs. The rate of increase slow down here. So 0.8% is the increase, and any time in the last 50 years we've seen this slow of an increase, it's preceded economic weakness, so a downturn in terms of the economy. The percentage of workers quitting their jobs, there's a quits rate down to 1.8%. That's the lowest since May 2020. So we had a very tight labor market, tightest in history. 3% was the quits rate back then. So people very comfortable quitting their jobs because there were so many job openings out there. And now we're seeing a tighter labor market, a looser labor market with fewer job openings out there, so people a little bit more reluctant to quit their jobs than back then. We also have the ADP data, which is a better read now than the non-farm payroll data because the non-farm payroll data has been delayed here due to the shutdowns. And what we're seeing is a 4,000 decline in private sector payrolls per month over the last 3 months, which is the first decline we've seen since 2020. So overall, what this means, labor market is weakening. People are debating whether that means recession or it just means a normalization in terms of the market. And the big question will be whether we start seeing big layoff announcements. So far, it's been really a restriction, more of a restriction in terms of new hiring than we've seen outright firing. So we're not seeing yet a big spike in terms of initial jobless claims. That would be the first place that you see it. Aren't yet seeing it there, thankfully. So maybe it's just a normalization of the labor market, but clearly different labor market than we had a few years ago. In terms of consumer spending, still contributing to GDP. Consumers is very, very grouchy, grumpy, many different ways to describe it. Sentiment very, very low, but that hasn't translated yet into really them pulling back in terms of their spending levels. Retail sales here up 3.9% over the last year. If you adjust it for inflation, up 80 basis points. So still spending in excess of inflation. A big reason for that is this chart right here, which I call the most important chart for an economy. And that's the fact that 29 consecutive months in a row now we've seen average hourly earnings, so people's wages outpace inflation. And that follows the longest period we've seen of the opposite, where people's wages weren't keeping pace with inflation for over 25 consecutive months. So that was not a good situation that we saw back then. Much better to be in this area right here. So hopefully 2026 we see continued wage growth in the US and continue to see that wage growth outpace inflation. So we'll end it right there. Thank you everyone for joining me on this special edition. If you're watching this on YouTube, take a quick moment and hit that subscribe button, and I'll see you next time on the regular edition of the Week in Charts.